ETFs, stocks, options, futures, forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show. Good morning, everybody. Happy Tuesday. Welcome back. We have ourselves a little bit of a choppy market this morning. Bulls are probably still looking to get a little bit out of this market. I would hope they're able to push up into the 5,800 level, maybe a little bit higher. Be warned that there's probably some bears hanging out in this like 58 to 58.50 zone. So just be mindful of that. I wouldn't mind seeing this melt up. I'm watching some trades. I've got some bull call spreads working out pretty nicely. I've got some credit spreads working out pretty nicely. Some trades in here looking better, looking better, looking better. A lot of these I'm just going to be managing through this week. This one's not awful. If we hang out, I mean, I could probably just take the profit in this one here and move on. Same thing here, but another, day or so, probably not looking awful. This one is fine. Oh, I'm going to close this one out real quick for another win. 25-cent debit, fine by me. How'd you not close out? I got the automatic trade, 26. All right, I fill at 26 for a winner. Very good. That one, I'm going to watch these for if we're just staying somewhat elevated by either a push up higher today or by the end of the week. If we're still above like the 5, let's say, pretty smooth sailing there. I just had a conversation in my previous session on a little COVID action. Here's what I'm looking at. So doesn't have to be crazy complicated. Here is a high. Here's a low. We're kind of right back into this harmonic merge level, which is potentially where these bears can hide out. I think more of the level I'm watching is going to be the 50% pullback zone, which is not that far away. So the bulls could still climb. We have a pretty solid gap right there, as well as that Thursday to Friday. Today was not much of a gap day. We just had a retest of it, so it's pretty efficient. But here's the 50% zone. So we pull back in this 50% zone. We look left on the chart. There's lots of previous lows back here around this like 55% zone. So let's just say from 5,800 to around 5,850. I could see the bears hiding out in there for a potential scratch of the market. Where to? Well, they can certainly pull back into this area to retest some gaps. But if we're able to at least get there first, I want to kind of assess my current positions to see, are there some more profit levels and profit targets I can take if we hit that equilibrium. So I'm going to set a chart alarm here around 58.20, and that's just in front of my 50% pullback level. So coming up to 50% pullback zone. That gives us just a little bit more drift. That allows the volatility index to continue to drop and settle back in. We've gone from, 29.55 or 29. What's the high here? 29.57 on the VIX all the way back down to 17. That's a pretty nice retreat on the VIX. 42% decline on the VIX. Now, if we were to turn all of a sudden and head back up, I mean, look left on the VIX. We've seen elevated VIX, but it's been settled here around the 15 or 16 handle. Okay, so going into, this like 15 handle, it's like I'd love to see the VIX continue to sell off a little bit more, get us into this like 15 handle, come back into the early parts of the year where we had, it's certainly not 11 VIX, it's not 12 VIX, but having a slightly higher like 14 to 15 VIX would make some sense. So if we can just push a little bit lower on VIX, get back into the 15s, that would kind of reset this instrument, which I think would make some sense. So hopefully there's a little bit more downside in the VIX, which means slightly more upside in the markets. All right. So let's go a little top down today. Let's go currency strength. I'm curious how this changes for the week. We've had 4 pretty terrible sentiment readings, which is, I've said this many times, but sentiment is not necessarily a signal, but I think it was a wise play to be taking some bites, taking some nibbles in the markets as this did sell off and we had some terrible readings. You had, for the first time in many years, you had the Dow, the Russell, the Nasdaq and the S&P all hitting oversold conditions. You had sentiment readings that were as bad as bear market territory, like we saw back in 2022. You had the volatility index up at inside the 10th percentile of volatility highs. I mean, nearly hitting 30. It's like usually something happens around 30. You can either have like that one-off spike above and then a hard reversion, or from elevated high 20s into 30s, it's like the market usually fades. You can look back a lot of years when you've seen 30 VIX. It's like even through 2022. COVID obviously had its bouts, um, but that was just elevated volatility in general after like the largest spike we've seen in VIX. But yeah, I mean, when you're in like the 30s, selling premium is pretty good. Here's your volatility event in December 18. Here's your volatility event in January, February of 18. Those were one-off, coming off of super low volatility. Then you're coming back into 2015, 16, where the market actually had like a 20% correction. But you can see just how this instrument is a reverting instrument. What I noticed on the VIX term structure yesterday is we did return to contango. So now the risk is further out. Instead of the risk being where this VIX term structure is higher volatility in the near term, this is now back in where it kind of typically shows, which is contango versus backwardation. So that's that. It's like all things are kind of returning to normal. I don't think we're done. I don't think the bears are done. I think the bears are potentially lying in wait, and we're going to find out where that is. But that's why I said, to me, this is like that 5,800 handle, 5,850 handle. If the market can just drift up a little bit higher, I think that's great. I don't think there's really any major catalyst to turn the market this week. I don't know what would be any. I mean, okay, let's look at the calendar. Today, pretty quiet. Tomorrow, durable goods is medium impact, and I mean, none of this really matters, I don't think. Unemployment claims, final GDP on Thursday, maybe. But if it's positive, maybe that's that final little push to the upside before core PCE on Friday. So I think if we don't have a lot of disruption, I mean, maybe Thursday, Friday, the market's like, okay, bulls have had their fun, bears can come back, but I'd almost expect to see the news in line with something bad. We'd have to have higher unemployment claims. GDP would have to be a pretty big miss, and then Friday's core PCE. Let me see if it's on the Bloomberg calendar here. Oops. Looking pretty good. Bloomberg for Friday. I want to see what the forecast is for the core PCE. Do they have it? So we got year-over-year core PCE with no forecast, year-over-year PCE with no forecast. Well, that's annoying. Personal income, personal spending, month-over-month forecasted at 0.3 to stay the same. All right, core PCE. It's one of these in here. This one, 2.6. So Fed rate still 4.25, 4.5, changing likely this summer. June is expected rate cut. Still around 2 cuts this year is what's expected from the Fed. If core PCE is the same or slightly lower, that's probably a good thing. If it's lower, that's probably a good thing. Let me take a look at Trueflation for a second. Okay. So we're going a little bit higher. I mean, is it unreasonable to think that, the Fed's 2% inflation target is going to be nearly impossible? I think if the Fed would just say that we're willing to tolerate, it's no longer like 2% inflation target, 2% inflation target, but rather 2 to 3%, 2 to 3%. Like they're clearly allowing it. It's like they're being more reactive when it comes to higher inflation. They're kind of hoping that things just naturally take their course, but I just think we're going to be in elevated inflation territory for longer. 2 to 3%, I would say, is manageable. It's not super scary, but it's just so far off from what the Fed is telling the market every single meeting, every single FOMC minutes report, every single Fed. It's like 2% inflation target. I mean, we had a 2% inflation target when we had deflation. So I don't know. I just I don't think the Fed is going to be that hawkish, because in order to probably get to 2% inflation, we probably have to see an overshoot, right? We'd have to be at we'll just say we're sitting around whatever. We're just gonna let's just take this. Okay. 2.6, or the headline CPI at what's headline CPI? Core CPI. So core CPI 2.2. That's core. So you exclude food and energy. Okay. Headline CPI, US headline CPI 2.8%. Okay. So this right here is going to get down to 2%. We're a long ways away from that. In order to get there, Fed has to not cut rates. We probably need to see a slowdown. I don't think, I mean, from a historical context, stagflation is a long ways off. Unemployment, unless we see a big, big uptick in initial jobless claims or continued jobless claims, we're not seeing really anything too scary in the labor market right now. So anyway, we're a long ways away. So this is what I'm talking about. The Fed, maybe for 2.5%, can say, okay, things are going well, but as long as we're less than 3 and we're trying to target 2%, like, okay, have a realistic conversation of where things are at, because there is a cycle of inflation. It can't just be inflation just goes straight down, right? I mean, we've seen it. You can see the Edge Finder tool. If you go to CPI, any of the inflation data, I mean, you can see from core PCE to PPI to CPI, a lot of the inflation data has been very sticky. So we are in the same area since literally, summer of 2023. Okay, sideways, a little bit lower, trended higher. We're sideways again. The histogram is finally improving on this one data point. Hooray, we finally trended lower for 1 month. But we're really no different a year later. A year and a half later, honestly. So not that great, but the narrative isn't changing. So, I mean, inflation does improve if the economy is slowing down. The 10-year yield, I think this is also going to be something sticky, and just quick conversation on this. We'll do top down, but not going here is probably good. Not going here, I'd love for the 10-year yield to drop. I really would. But I think in order for this 10-year yield to drop, we would have to see a bigger decline in stock market, more risk off trading, and probably consumer spending freeze and potential threat of major slowdown. So I think that as much as the 10-year, the government may want this. I mean, sure, consumers want this. I'm sure like any type of refinancing coming later this year wants this. I want this as, closing in a house in a month or two. I want this to be as low as possible. But I think in order to get this lower, the only way we made progress on this 10-year yield is by what happening. We made progress on this 10-year yield by the market falling hard, fast, and so in order for us to get another significant chunk out of this 10-year yield, you're going to have to see a bigger stock market decline. So I don't know if we're going to get that. If this market's like, hey, the bottom is in and we're going to go back up to, all-time high, maybe. If we get back to all-time highs, this 10-year yield's not going to go lower. So I think the reality is, like, we have the high for the year in early February. We put in our intermediate low just these last couple weeks. And that 10% swing, I'll just talk SPX for a second. So that about 10.3% swing. If the market finds equilibrium and can't quite break highs or lows, okay, well, then this is going to stay right where it is. And it's, it's not breaking the bank, but it's certainly not getting better. So maybe that's our normal. Maybe this is just an absolute grind fest for the next maybe 30 to 60 days. Now, seasonality wise, having a high, having a low, the market starts to pick up and we can kind of, fight through Liberation Day and the tariff talk is a little bit softer, maybe the market takes that as a good thing and we do get to all-time highs again. I'm still pretty darn cautious that all-time highs don't have a ton of momentum behind it. So I'm going to reallocate, rehedge. Yesterday was a really active day. I'm now up to around just shy of 50% of my portfolio is now cash, which is good. That's where I wanted it to be. So I mean, I've got plenty of cash to deploy, trades to close up for more profit. Positions are looking fine, but I want to be still defensive. I want to be cautious. I want to have cash at the ready in case we have other volatility events. All right. So as much as this to go lower is going to be very difficult, I think at the same time, this would be the most frustrating if the 10-year goes higher, because this could be a good run for the market. Like the markets could go higher, assets could appreciate, but then we get into a bubble. And that to me has bigger implications, ramifications, and consequences that all of a sudden, like this move for a correction is not just a 10% buy the dip. This is a 20, 25, 30%. Holy shit, we're in a market correction. Right? Like that's my bigger concern, is that we get into another bubble situation like we had in 2019 that crashed in 2020, like we had in a deleveraging in 2022, and it doesn't stop at 20%, doesn't stop at 25%. Like, I mean, I put this in context and then we'll do some more analysis here, but let's just go perspective. Let's go summary. Just go bear. Is it drawdown? S&P. There it is, drawdown perspective. Here you go. So intra-year decline, we're talking like bigger picture, right? So a 10% pullback happens about 64% of the time, and it happens every 1.5 years. Okay. It happened in 2024. It happened in 2025. Well, there you go. Checks the box. Pretty accurate. I'm talking about the bigger stuff that's way more painful. But this pain, by the way, 15, 20, 25% pullbacks, they happen very infrequently, right? Anything higher than that, obviously very infrequently. But realistically, a 15 to 20% pullback every 2.5 to 4 years, we're kind of coming up on that, because a 20% pullback last time we saw it was 2022, right? So is it spot on where it's like, okay, 4 years, let's get ready for it? I mean, obviously it doesn't have to happen, but if our last 15 to 20% pullback was 2022 and we have another one, let's say late 2025 or into 2026, I mean, it's not a high probability, but when it does happen, it typically offers up really good opportunities to be braced for a downside move and also positioning for the ability. So, you look at like Warren Buffett saying is like, don't time the market, you can't time the market. Well, if you're paying attention, it's not obviously easy to time the market. But what is a little bit nicer is like having some cash at the ready, where if you do have this correction, man, it's nice to have the cash ready to deploy at these bigger correction levels. I, for one, like to sell a bunch of premium during this time when the volatility is high, and a lot of those trades work out very nicely. But also going out far enough where you can kind of position for the market, give the market time to find its lows, give the market time to bottom out. And you got to, I mean, you never know how quickly the market's going to recover, right? A lot of times this market has been spoiling traders with this: a correction by the dip, a correction by the dip, right? A 10% slide. Even this, look, we bottomed out 10%. We had a couple days of indecision, and then we had a gap, and then from there it has been going higher. Like this still is barely making traders wait, right? This is a lot different than in 2022 when we had down and up and down and up and down and up and down and then down again. Okay. And then it finally bottomed out over here, but it took months to then carve out that low. That is a lot different waiting game and experience to be patient on the 10% pullback level, 20% pullback level. That's harder. It's way harder, but you got to be picture like, 6 months out, 12 months out, see the light at the end of the tunnel, and yeah, the market can get through it. But I just think it's amazing how traders have been so instantly gratified by V bottoms. It's crazy. But that's what the market's been giving us, and these cycles are happening faster, and it probably will continue to offer that with zero DTEs and this combination of, institutional buying and retail buying, and you can do it every single day. So what does that do? It just makes things move faster. So anyway, we'll see. All right, let's go top down. So we are green on the day just by a little bit. SP up, SPY is up 0.34, SPX up 0.28, Nasdaq 0.46, Q's up 0.49. Let me talk technicals here on the Qs. So we're just above the 200 moving average. Mags also back above the 200 moving average. This is a good sign. I think this is a great sign. Let's go Mags for a second here. I don't even know where to draw a fib from the bottom, honestly. I really don't. Like maybe, I mean, this doesn't go back to 2022. So I guess the better trade would be this on Mags, just for a high to low. If we're going to say that's our flush to the downside, see where this thing pulls back. So there's room to pull back to the 30%. There's room to pull back to the 38%. There's obviously room to get back to equilibrium. So if Mags can lead the charge for this additional comeback, then to me that means that the whole market can lift. Yesterday, advanced decline was pretty good. We had like 71% of stocks advancing yesterday. A little bit more mixed today. 45 declining, 47 advancing. But if Mag's got above the 200 moving average, we have another move higher. Like we can get to this. This is such a cheap ETF to play, by the way. At 45, like they're good companies. They're good companies. I think the problem is are we going to get exponential growth, or are we getting to like the maturity phase of these? I don't know. I mean, we just had like a very harsh lesson in concentration. Every portfolio, every 401k, every index, super biased and concentrated in just 7 stocks. The market clearly needed to broaden out a little bit, and it did so like we discussed in the very beginning of the year, which is the market can broaden out with the downturn. That's what happened. So now if the market is going to claw back more, with more bullishness, it hopefully claws back with a fair distribution. And it's not just Mag 7. Even though the PE ratios of Mag 7 did rebalance very quickly, it did make the overall market a little bit more attractive. So anyway, but we're drifting higher today. Dow is up 0.23%. Russell is flat on the day. I did take some profit on IWM. I think I closed out most of these for the week. I had a couple expirations out to late March and into May. And I think I closed both of these out, but let me double check that. So IWM, I think I have some shares only. Yep. So just the shares and a covered call. But I closed out these 2 trades for profit. So this one closed out. This one closed out. Took about, and a lot of my trades yesterday were anywhere between like 70% of credit, and some of my like 111 trades were like 100, 110% of credit. So I mean, I had a bunch of good profits yesterday. These trades are closed. So this one, close winner, and close winner, and I don't have to wait to expiration. Let me double check on all accounts for IWM. Just shares, just covers. Yep. So I closed out all those premium trades. Good. Copper. I should have a silver trade that's closing out here tomorrow. Yep. So I've got silver up around $900. That's silver futures. That's gold and silver up $3,000. Let's take a look at gold, silver, oil, dollar, all that good stuff. We are melting up a little bit higher. Volatility index, again, heading down. I'd love to see this settling into like $15 or so, 15 points. Son of a biscuit. Well, maybe next time. I wanted to, I mean, if you remember being in the session with me, I was looking at selling some puts on SVXY. It was a good trade. I have to be willing just to buy the shares. It's not a margin instrument. I had to be willing to buy the shares. Nothing crazy. Like if I bought, 100 shares worth and it's up $4, make a few dollars there, that would have been fine. But yeah, maybe next time. Dollar index. Is that it? I don't know if that's it. 1 hour chart. Let's go to the 4-hour chart. So this is still my inefficiency zone in the dollar in here. Um, it's possible that the dollar is going to turn, sooner than later. But I'd like to see a bit more of a pullback in here towards the 144 to 200 moving average. I'd like to see the dollar pull back into that inefficiency area, then look for a trend line break. So maybe a little bit more of a chop to the upside on the dollar, and then this thing can turn over. So I still do like with stop losses above this recent high, above this trend line high. I would like to see if we can line up like a nice high reward to risk trade on the dollar. So euro dollar is probably my better position on that. If you want to trade Aussie dollar, New Zealand dollar, that's okay. I wouldn't do pound dollar. I don't like pound dollar very much. I think euro dollar looks a little bit cleaner. But based on the daily chart, just watching this big like 3-day sell-off, that was a monster move. So we pull back into here, pull back into here, pull back into here. Any type of shorter trend line confirmation, stop loss above the outer trend line right here. I think that's a good spot. If we continue to drive lower, good. So if you get a good entry, I would be watching. I'll flip this over to euro dollar. So I'd like to see a bit more of a pullback. Again, you can see that area. So is it something like this, enough to connect the trend line? We get on the right-hand side of the trend line, start to head higher. This would be my profit target. If I'm going long euro dollar, that's my profit target. And hopefully risk-wise is we get a turn. We're looking at like a small risk to a favorable reward. Not too bad. Let me go currency since we're talking about it. Still long Aussie CAD. Aussie Swiss still stacked up. Aussie yen. I had a trader ask me yesterday, like CAD yen, New Zealand yen. I keep saying this, watch these like flash crash lows. The market is responding off of this. Just be careful. I mean, in general, just be careful in the yen. We don't, I guess the one talking point in the yen would be, is the Bank of Japan going to be raising rates again through 2025? I don't think that's in the plan right now, but they're sitting at 0.5%. If they raise to 0.75, if they raise to 1%, that does threaten this whole idea of this like easy money carry trade. It is like that's a big threat because now all of a sudden your swap and your positive rollover is going to be negligible, because you have other central banks like, look, the Fed's going to be cutting this summer, right? Bank of England's probably cutting once or twice this year. Bank of Canada's already cut a ton. New Zealand's cut. Australia's cut. Eurozone, they've cut. It's like if you have one bank that's going higher in interest rates while others are falling, I could see. I mean, it happened last year, and it was like the preview of maybe this is round one, right? Round one, and then it's just a bunch of noise. But if we have a round two, does it actually go to a higher low? Is it this? Is it round one, a bunch of noise, okay, or is it that? Right? Do we come all the way back up and just have like an obvious like tell repeat? And this is round one, this is round two, and it's just like this super kind of nice technical. I mean, I don't think so. That'd be like the perfect environment for that to happen. But if we have a swing and everyone's just kind of waiting and thinking about it, and this ends up going lower, well, this is easy. This is a high to low, this is a lower high to lower low, but that comes at a lot of risk. Like that's a big risk off flow. I mean, that scared the heck out of the market last year, right? It could do the same thing again. But I also think that we would have the heavier degree of deleveraging if we have another round two of that with the Bank of Japan. Aussie New Zealand, I'm still going to hold long here. I don't really love this trade at all, but it's postured for maybe a revisit of the highs. We've been making higher highs and higher lows this entire time. So I'm just looking for something like that on the Aussie New Zealand. That structure plays out. I do like this sell trade. If we get back to these highs around 114 or so, I love that sell trade back down to like 107 or 106. So I'm just going to hold the longs right now and see if they get back up to recent highs. That'll be kind of a profit target for me. And then it's no trade. maybe sell high, and then definitely buying low. But in the middle, it's like this pair is awful. I actually I take that back. It's one of my favorite currency pairs when it's at levels I want to trade, but it looks like it's just a chop fest. Aussie New Zealand, no trade. That trade is done. I close this one out, so I can delete this. I'm still going to buy this thing around 6,000. CAD Swiss got some stacked up levels to the upside, trying to get back to 6,500. CAD Yen, again, watch your flash crash low. It's responding off of that. Just use stop losses, use a good trading plan, align your time frames. Swiss Yen, no trade. Euro Aussie, we talked about a short-term top coming in, high, lower, low, even pulling back to like the 382 or 50. So there's probably some opportunities to still be short on this one in the near term. I'm not in it. I'm just saying, like, once we put in a high to low, look at a little swing trade, try to find some equilibrium. Euro CAD, no pullback, but possibly same type of thing. There's a low, there's a high. If this pulls back at all and then sells off, you go back to previous resistance becoming support, maybe around the 50% zone. Not a bad spot. So a lot of these kind of silly looking runs we saw for a couple weeks are going to balance. Euro Swiss, it's fine. Still going to stack this thing up towards 98.80. Euro pound, no trade. I'm out of that one. I bought this thing at equal lows, took it up to the 200 moving average. Euro again, no trade. If you bought this thing at July, August lows last year, that worked out great. That was up about 700 pips. That's it. I mean, if we get a chance to do it again, if it comes all the way back down, you hit the lows again, look for some confirmation. That's not a bad trade to get some higher reward than risk. Otherwise, I don't think there's a good trade in this at all. If you're paying attention on the shorter time frame, maybe that trade. If you confirm it, stop loss above, go back down to the lows. Just as I warn, is just be careful on yen crosses. You're New Zealand's. There's a low, there's a high. Is it going to be just a pullback to equilibrium? Well, there's lots of resistance in here that could become support. So a little bit more downside could make some sense. I think a short-term alignment for some scalping might not be a bad thing. Euro dollar, I'd like to see a bit more of a pullback. Bit more of a pullback into here, get a nice little trend line break, and then look for more upside if we get it. This 107, 106, 105 zone, if it holds, I think that looks great. It really does. I'd be really, really surprised to see the euro dollar get back to parity. After this type of move, after that type of drop in the DXY, I'd be really surprised to see parity. It certainly looked doable when we were down to like 102. I'm like, okay, well, any pullback here looks good to sell. Didn't happen. So, I mean, I think it's flipped quite a bit where this market now taking out this high, retesting. I think this is a very strong support zone. And to me, this is resistance. So if you can find some opportunity in there, I like that trade. Pound Aussie. I mean, maybe equal highs. Maybe a little bit of chop fest up here. I don't like this one as much. I think the Euro pairs are better. Euro Aussie, Euro New Zealand, Euro CAD, even those are a little bit cleaner. Pound CAD starting to turn a little bit. Pound Swiss, I'm still holding long. Pound Yen, no trade. Pound New Zealand, same. I think Euro pairs are better. They're structurally, they're a little bit better. They're cooperating technically better. Pound dollar, not interested. New Zealand CAD, just buying all the lows here. So any equal low, buying, any equal low, buying, take it back to a range high. So if you buy low, take it to the halfway point or take it to resistance. It's just a big range. It's not too bad. Euro dollar is a better trade to me, James. I think it's easier trade. Pound dollar, I mean, right now it's like, what are you going to do with it? I say that because I think the Eurozone is willing to do a little bit more fiscal policy than the UK. I think the UK is also experiencing higher inflation. UK is certainly more in like an island economy, meaning like they don't have all the crazy support that they did when they were in the Eurozone. Brexit was a very real thing, and the UK is operating its own 2 feet. And I think the Eurozone is slightly better positioned with Germany kind of coming off their austerity measures and willing to spend more, whether it's all defensive or it's going to be something in just the entire Eurozone economy to benefit. Like Germany is enough to like lift the tide. So I just think the UK is in a little bit rougher shape economically than the Eurozone. So I think Euro is a cleaner trade. Okay, Euro New Zealand. Yeah, a little retracement. Look for like a 50% pullback on that recent swing from low to high. I'm going to get rid of one trade really quickly on SPX in case we're going to climb. Actually, no, it's fine. Okay, just watching this. Spot checking there. I've got this pending order for a broken wing butterfly. It's probably not going to fill today. This one's in for 55 cents, and right now it's trading at, see here, closer. It's crazy how I'm taking on heat with this trade that's like 20 points higher than my sell put level. That one's in profit. 76% of my profit is available. Need a little bit more time. This one's okay. So I'm up 55%. I'm up 76%. I might manage those by the end of the day just to take these off the table. This one is another waterfall. There we go. I've got a trade in on SPX today. So it's the 25th right here. So that's a broken wing. This one is a waterfall trade. There we go. So this trade yesterday was up around like $60. Now it's up 115. I like this a lot, and I'm up about 62 points. So I'm going to possibly close this one out for profit. That would be about a $200 winner because I had a part of this was a bear put spread, which was a profit trap. I grabbed 110 bucks out of that, and then I've got 115 right here. So a little bit. I mean, this goes out to Monday. So honestly, unless we come all the way back down to 55.10, this trade is not threatened. I've got $183 on this trade. I might just let this one run through the week and evaluate this like Wednesday after market or Thursday. We have GDP news on Thursday with jobless claims. We've got PCE on Friday. I don't think that's a massive mover. But like I said, I'm a little cautious where those bears can step back in. So, all right, just keep an eye on things. Okay, New Zealand CAD, we did New Zealand Swiss stacked in, still trading really small. Looking at this area from this July, August low last year to offer up a bottom. This would be an excellent trade just to watch. And once you get on the right-hand side of this trend line, I think, I mean, honestly, I might add more positions in here if I really like it. But just waiting for a trend line to break, waiting to see if this double bottom area holds, waiting to see if the bulls can take out a recent high. If the bulls can take out a high, then my structure changes, and yes, I will be adding more positions here. I think this is a double bottom trade where we have a low, we have a high. I'm getting back to this recent high for a profit target. If I double that move, we can come back obviously a lot higher than that. I really would love to see the New Zealand Swiss get back to 6,000. So, but the way to measure that would be, let's say we have a 1, 2, 3. Well, I'll go 4, 5, and then I'll try to take like all my profits on a fifth wave move. But that wave structure hasn't happened yet. New Zealand yen off the lows. That's about it. Just be patient on that one. New Zealand dollar. This trade's done. I'm out of this trade. I'm still willing to buy this New Zealand dollar at this major support. So between 5,500, even down to like 5,000, I'm willing to scale myself into New Zealand dollar. I don't think there's not a lot of like lower lows here. I mean, this is 4,900. We saw obviously major bounces going back to like the initial retail price at 2002 and 2009. I don't know if we get there. Like this low might be the low, and this market may head back into like 6,400. I mean, heck, it might even come all the way back to this range level around 7,200. So what I don't have yet is a bullish price pattern. That's the one thing I'm missing, right? So I mean, if this was a kind of a cup and handle look, like maybe that swing trade's an opportunity. If we come back in and like retest the lows and that rejects, I mean, one thing that'd be nice about the New Zealand dollar would be, let's say we test the lows. Well, if I put in buy stops and price goes lower, I don't get filled on buy stops. But if price bounces back up and all of a sudden we get this nice little wave coming back into range levels, you can get filled on some buy stops, stop loss below whatever U-turn that is, and then hopefully we see like another wave of dollar weakness. So I still think this area looks pretty good. This is strong support from 2020, 2022. If it went any lower, I'm still interested in buying like crazy lows. So like I said, if this came back to like 5,500, I would be willing to scale in all the way down to like 5,000 and just trade this thing really small and then get like a big, I mean, I would be surprised to see like 1,000+ swing. Okay, dollar CAD, no thanks. I had my fun. I had my trade. I'm out. Dollar Swiss. I'd love a pullback towards equal lows. 86, 85, 84. If it loads back up, I'd love that trade back up to a range level. Dollar yen. I mean, if a weaker dollar prevails, this is one trade that, this is possibly going to give you the clues of maybe the Japanese yen deleveraging if we have something like this. If we pull back here and it starts to roll over, because then we have a symmetry swing. Then we have a move back down to the lows again. This would be your high. This would be your low. If you can line this up for another leg lower, what potentially is a better trade would be this high to low. You have a topping pattern in here, but you project this move down to symmetry. So high to low, lower high to lower low. That's the yellow box. The hard part is how do you time this trade? If this is just a slow grind to the upside, it's like just wait for a clean trend line break and hope that this thing wants to push. If it doesn't push, be prepared for chop, be prepared for maybe retest the same high again. Like, don't call this thing without confirmation. Okay. All right. Let's go oil, gold, silver. Dow, I mean, it's same thing as all the other indexes. US 30, that's your Dow play. So, I mean, where are we pulling back to? Got a 50% zone right around this 426 handle, 428 handle. So if you go US 30, there's some decent support in here. Goes back to August of 2024. We go back a little bit lower from the 2022 bear market, out to there with that 2023 pullback. And that's like way outer trendline stuff there. But so far, it's holding up. I think we're going to be struggling to make highs, but the market may put in. I don't. This might have what it takes to get back to these highs again. It's going to be a tricky environment. I don't know. I'm not 2026, 2027. I'm going back to this thought here. Where's my screenshot? Oh, well, the bear market, like every 1.5 to 2 years, every 3 to 4 years. I think this market is going to face some problems. Doesn't mean I'm not bearish. I mean, obviously bears can wait years and years and years to be proven right, and they can still lose. So I'm just looking at it as have cash at the ready, trade defensively this year, grind it out, a lot of active positions, good mechanics, good probabilities, and that's hopefully how I survive the year doing really well. And that's, I mean, honestly, that's every year. It's like for you to say like, oh, I bought the bottom and I called the top. It's like, that's impossible, nearly impossible. That's not my job. My job is like, if I can get the lion's share of the move. So let's say that, okay, this decline was, okay, I'm taking some nibbles. Well, if I get that right, cool, I make some money. If I'm cautious at the top and the market does head back down, okay, well, hedging works out pretty nicely. So just pick your battles, tops and bottoms, very challenging, very difficult. Certainly the bull markets can stay longer than people think. The bear market can come and be uglier and nastier than people think too. So it's never going to be a game of just trying to get it perfectly like spot on. It's more of the game of don't do anything stupid, survive like anything you think the market can throw at you, prepare for like worst case scenario. This is why I trade define risk. I think worst case scenario is like if we have a 20% dip in the market or a 50% dip in the market, can I survive that? If I can, it's because I have defined risk, so nobody knows. And because of all the emotions and all the noise and all the flows that come in now every single day, it's like 55% of all option volume is daily. It's like this market it's like a goldfish. Like today, it's all today. Everything today matters. It's war. And then tomorrow, it's a new day. So it's really weird how this market can just kind of have like these wild like day-to-day cycles when in the bigger picture, it's kind of the same thing. Bigger picture, stay long-term oriented, be bullish. you know, it's proven over nearly a century to be pretty lucrative. It's not going to come without pain, but if you give yourself a 5, 10, 20-year horizon, there's ways to make money in these markets that are, why wealthy people have stayed wealthy. Um, I do wonder if Bitcoin, just on that quick conversation, it's like, is Bitcoin that asset that allows people to catch up? Those that haven't had the money to invest and they, only have $5,000 or $10,000, not hundreds of $1,000s, but Bitcoin's performance is good enough that the returns have just allowing traders to compound and catch up, maybe, but now Bitcoin's a little bit more securitized. It's certainly a lot more correlated with risk appetite. So Bitcoin trading around 88 right now. We're still not on the right-hand side of the trend line. I still think if the market's going to have like another claw from the bears, that Bitcoin is going to be, facing another test of this like 75K support. I'm a much different bull on Bitcoin if we can break this trend line, right? I mean, if we go up here and then head back down, probably the market goes with it. If we stay in here, but we break this trend line and we hold this resilience, and this is resistance becoming support, then yeah, I'm a much better buyer there. But I also wonder, like, is this going to help time the broader market? Because this is a poster child for risk appetite. Okay. So, all right, I'm going to go for just a couple more minutes. Let's do oil. Oil. I still don't love oil, to be honest. I think that the U.S. right now wants to see lower oil prices. They want to drill. They want to deregulate. That could be this catalyst to driving prices lower. I don't know if this gets uglier, by the way. I mean, not all countries can operate with cheaper oil prices. So the U.S. wants it. Saudi Arabia wants it. That would be a market share play if they got it. But, U.S. wants lower inflation. To do that, driving energy prices lower would certainly help. So I mean, there's a chance, and this level has held up nicely. Like technically, this has held up nicely, but that's a short-term play to me. I don't see oil making new highs. If we're lucky, it goes up and makes another lower high, and this still continues to be this type of structure. And if it just keeps beating the floor, beating the floor, beating the floor, at some point, I think this floor breaks. So my trades on oil, I mean, if you're in it, there's trades. Like I mean, there's a lot of indecision. It's a lot of chop. It's lower volatility. Strangles work well in oil futures. Just, mechanically, ideally, as you go out like 45 to 50 days and you manage at the halfway point. So about, 20 to 25 days left in the trade. If you're in profit, take your profit. That's one trade. The other one I talked about was doing like a option trade, just like a bull call spread, trying to find the floor with a bit of asymmetry so you can, risk $200 to make $250. And if it works out, grab some partial profit or whatever, be done. That's about it. But I think in the bigger picture, it's like, I don't think oil has really any major direction to go outside of just breaking the lows. I think it's a lot harder for oil to have a big bull market. Oil to me is like, once we break this floor, that's where it gets ugly. Like we break the floor, we're talking oil at 60, talking oil at 50 and change. I mean, how low does it go? Well, we know it can go to zero because it did. So just it's very choppy. But I think in that, in the trenches, if you want to trade like actively, it's like strangles, iron condors, they work pretty well because it's such a choppy market. It works out okay. I'm still going to hold natural gas long, and hopefully this is officially rolled into a bull market. It's just a matter of getting the pullbacks. Gold, 30.24. We've retreated off the highs a little bit. This is good. My position on gold futures is looking pretty good. Let's go gold futures here. So I'm up $500. That's actually like most of my profit is achieved. So let me see if I can close this thing down. I'll just take the profit and move on. So a 10-cent debit. So that gives me $1.10 if I close this thing out. Let me see if it'll close out at 10 cents. So 10-cent debit. Actually, yeah, it's not going to take. It's only 30 days away. Probability of profit is really high in this trade. Right now, I'm sitting at about a 91 to 94% chance of keeping my 3250 call profitable. Gold would have to do something very atypical to make a run and threaten that position, but I've got a profit trap. This is what the trade looks like. So this is current price on the futures contract. I do have a profit trap a little bit higher. So this is a $500 profit trap. And then my risk on the trade is all the way out here to the 3250 zone. So, out of the money percent, like I said, is very high. Only 30 days left in the trade. But the nice thing is I'm already seeing a majority of the profit, and I'm getting a bit of a ramp up on the out of the money. So I'm just trying to close it out. I mean, I can just close maybe at I don't know if I can do a zero. I can't do like a zero debit. I could do a 10 debit, but then I'm taking a little less profit. So I'm just gonna, I don't know, I'll probably look at it by the end of the week. But right now, it's like the trade I took initially was $1.20, and it's trading at $1.25. So it's fine. I'm actually up 100. I mean, it says I'm up in profit, right? Like it says, I get a little bit of profit trap right there. I'm going to see if that will fill, and that would give me $130 a contract instead of 120, which is what I took in initially. So the trade is good. It's just, can I get it to close out where I want? All right, that's gold. Silver's having a pretty good day. Happy with that. I want to see silver continue to make higher highs. I do have some covered calls on silver, if I'm not mistaken. So shares covered at 35 in SLV, bull put spread right there, and then a diagonal spread, which is the 15 by 34. That's a $19 winner for a 1389. This is out to 2027. So like long-term trades for me, UNG, Pfizer, TLT, SLV. Those are long-term. Like I'm trading basically calls, a long call out to 2027. And then every 3 months or so, I'm selling a call against it above my break even, trying to grab some income. And yeah, I mean, that diagonal spread's up $580. And with a 3 contract trade, I think my max here would be, that'd be 19. Do the math. So 1389. That and 3 contracts, I make $1,500. So I'm up about 33% of my trade right now. But it's out to June. So anyway, but silver's looking fine. Technically, I really like silver. I'd love to see silver heading higher. I'd love to see gold heading higher. I just want to see gold get a pullback. Okay, Bitcoin we talked about. MicroStrategy up into the threes again, 338. I would be totally fine if Bitcoin is looking more resilient. Bitcoin's higher, markets are higher, then I'll probably do another roll or two on this one. I have 300 shares of MicroStrategy. Break even is at 263. Even if I get it called away at 310, roll it out again, maybe a week at a time, and see if that will, offer up another $1,000 to $1,500 of just income on just rolls, like rolling the covered calls. Coinbase. This one I'm watching for this week. I need it to stay above 195 to avoid assignment. There's an income trade right there. If it's hanging out right around this, it's a 205, 20. Yeah, so this is actually part of my profit trap. If we're at 205 to 200, there's a profit trap window right there. So let's say it just closes where it is right now. Well, that's a dollar profit trap on top of the $1.07 credit. So that's an income trade. And my avoid, not really avoid, but if price is above 195 by Friday, then I keep the full credit and possibly have a profit trap. So a couple of good things to continue with this week is my Tesla trades could get called away, which I just do a quick repair. And I'm going to add this to my YouTube channel. I'm just going to talk about what I did on Tesla from the initial trade. And then I own the shares and I have a covered call. And right now, that to me is, helping me lower my cost basis. And I'll turn this into a 247.83 minus 1666 get it called away at 247.50. I'm flipping Tesla for about a $1,600 winner in a week. Now, granted, if I didn't do anything on Tesla, well, I'd be up about $3,000 right now. That's the truth. Like if I didn't do anything and it's up from, my break even up to 277, I'd be up $3,000 in Tesla. Okay. So did I shortchange myself? I mean, yes, a little bit. But in the event that Tesla, let's say, comes back down, well, I lowered my cost basis down to 220 and change. Like, so even if I wanted to sit on Tesla, I'm lowering my cost basis. Anyway, and I have, look, the reason why is this is an income trade that is up about 90%. I'm going to go ahead and probably close this one out for profit. This one's another one for April and another one for May. I'm just going to give these one more time. I might just flip it again for income. So this one I'm probably going to take profit on. This one I'm going to get it repaired and take another $1,500–$1,600. And I think that's good. So Tesla, this trade, this account. Yeah. So this one, 127, as long as it stays above 250, it's, I mean, by Friday, this will be full profit. I'm up about 90% of the profit right now. This one, have another couple income trades, and then I sold some premium when Tesla was really beat down. I did a pretty wide credit spread that I'd be happily willing to own Tesla around 190 or less. So anyway, but I'm gonna do a video on that one, just talking about using options, calculating your break even, and doing a quick repair. Okay, all right, I'm gonna let you go. Have a great rest of the day, and we'll be back at it tomorrow. Thanks, everybody. Take care. Bye.
Thanks for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. Want more from A1 Trading? Check out the links in the description below, or our website a1trading.com. We have lots of free trading tools and channels available for you. We hope you have a great rest of your day, and we'll see you tomorrow.